Consultants, are you thinking about what you should be doing this time of the year regarding taxes? I'm recording this video in November, and we've been having this conversation year round for the clients that say yes to profits. We avoid waiting until the last minute to talk about taxes because they will affect your business in a great way if you wait to the last minute. But I know that many consultants are just now starting to think about taxes. You're probably wondering and maybe worrying about the tax bill that is coming soon and your potential tax liabilities. And you're probably trying to figure out, is there something that you can do right now that will save you come tax time? Well, does this sound familiar? If so, have no fear. Don't worry anymore because I will discuss year end tax savings that you probably haven't heard of, but that could benefit you greatly come tax time. Stay tuned.
Welcome to Say Yes to Profits, a virtual CFO firm that helps consultants gain clarity, control, and confidence in their numbers so that they reduce business taxes and build profitable million-dollar businesses. We exist to eradicate small business failure, so subscribe today, and as a result, we will make it rain money in your business. It is time for you to say yes to profits.
Hello, consultants. I am Octavia, CEO of Say Yes to Profits. Welcome to another episode. Be sure to hit the like, subscribe, and share button right now. As a firm owner, there are strategies that you can implement right now that will legally and ethically reduce your taxable income. And as a result, you will reduce your tax liabilities. Now, before I get into those strategies, I want to make sure that you're crystal clear on your taxable income for an LLC versus an S corporation. Now, your taxable income is a result of subtracting your expenses and cost of goods sold from the revenue you earn for the year. The result, in most cases, will be a net profit. This net profit amount is your taxable income. If your firm is structured as an LLC, you are taxed on the net profit you generated in your business for the year. But suppose your consulting firm is structured as an S corporation. Now, in that case, you will pay ordinary income tax on the distribution portion you receive from your business and self employment taxes on your salary portion. Taxes are not levied on the business level for the net profit that you generate as an S corporation. Are you with me so far? Let me know if you have any questions below regarding your taxable income as an LLC versus an S Corp. Now, here's the thing with either structure, you can implement the tax strategies that I'm going to discuss today, and they will help you reduce your tax liability. So, without further ado, let's get into it. First strategy, purchase tax write off items. Now, there are certain items such as equipment, training, office supplies, education expenses, consulting services, accounting expenses. Hello, say yes to profits, attorney fees, and other cost of goods sold and expenses that you can purchase right now that will lower your taxable income and as a result, lower your tax liability. As a consulting firm owner, I want you to think about those items that are write offs for businesses such as yours and make it your mission to spend in those areas for the remainder of this year. As a matter of fact, just because you are watching, I will link a tax deduction checklist below that normally I only give to my clients. I'll give you a preview of it that will list some of the known tax write offs for consultants and service based businesses. So click that link in the description and grab that list today. And again, make it your mission to spend in those areas that will benefit your business right now because they will also help your business come tax time. Now, I must say, be sure to speak with your accountant about certain asset items, such as vehicle and some equipment, because they function a little different depending on if you're capitalizing them or not. Okay. But for this tax tip, you want to again spend strategically. Use the tax deduction checklist to know where to spend strategically because spending wisely can save you hundreds of dollars in taxes. Strategy number two, delay invoicing and revenue collection. Delaying invoicing your clients or collecting revenue on the cash basis of accounting is a tax saving strategy. Yes, it absolutely is. Now, with the cash basis, you are recording revenue when you receive it and expenses when they occur. With me so far? If you don't receive the revenue until next year, it will not affect this year's taxes. Your net profit will not increase when you subtract your expenses and cost of goods sold from your revenue because you are not collecting the cash, aka revenue, this year. Okay? Now, I want you to use this strategy within reason and factor all aspects of your business because this could affect it significantly. Depending on where you are in business, this strategy could be beneficial and save you thousands of dollars from a tax perspective. But on the flip side, depending on your firm's current cash position, this strategy could do more harm than good, especially if you are currently strapped for cash. With this strategy, you basically push your profits and any new money due to come into your business until the following year. Bottom line, I recommend you consult with your accountant and create scenarios to weigh all of your options when using this strategy. Strategy number three, max out tax deferred retirement plans. A tax deferred savings plan is an investment account that allows a taxpayer to postpone paying taxes on the money invested in that tax deferred retirement plan until it is withdrawn. Okay. With a tax deferred retirement plan, you realize the tax savings, get this, when you contribute to the plan. Now, examples of tax deferred retirement plans include 401k, SEP, traditional IRA, solo 401k, and more. Now, the caveat with these types of plans is that when you withdraw the funds, you will be taxed at that time. So, be very clear and very careful the type of retirement plan you start with your business or yourself for that matter, because a Roth IRA does not provide tax savings in the year in which you contribute to it. With a Roth IRA, the tax savings happen when you withdraw the money. All right. A Roth IRA is opposite of the tax deferred plans that I'm discussing in this strategy. With the tax deferred retirement plans that we just mentioned, you have to open them by the end of this year. However, you're allowed to contribute to the plan up until April 15th, and that will save you tax wise with those plans as of the date of this video. Okay. Now, here's the thing. I highly recommend you speak with a financial advisor because I am not one. Therefore, I am not providing you with investment advice. Don't say Octavia told you anything, okay? I am telling you, speak with your financial advisor to make sure that this works for you. I am an accountant and I probably would love to be your accountant too. But at any rate, speak with your financial planner and use this strategy at your own risk, okay? Now, a couple of things I want to leave you with. With these year end tax saving strategies, I am not recommending that you aim to have a net loss for your consulting firm. If you have a net loss, that means you are not generating enough revenue or your expenses and cost of goods sold are too high. Therefore, you are probably experiencing or on the verge of experiencing cash flow problems. And that's not the position that you want to be in. With these tax saving strategies, if you're experiencing or on the verge of experiencing cash flow problems, these strategies will do more harm than good. All right. As a matter of fact, Paying taxes is not a bad thing. Yes, I said that. And allow me to explain. Paying taxes means you made money. You likely generated more revenue than you paid in expenses and cost of goods sold for the year. That's the position you should aim to be in as a consultant. You are in business to make money, 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 period. This green stuff here, okay? So you want to make sure that you're generating more revenue than you're paying in expenses and that you are using tax strategies to pay the smallest legal, ethical amount possible in taxes. Also, if you haven't calculated your year-end net profit or your potential tax liability, now is the time to do that. You do not want surprises, big, huge, sad, hurtful surprises come tax time. Schedule a meeting with your accountant today. Create scenarios using these strategies. See if they work for your business. If you do not have an accountant or you're not happy with your accountant, we would love to speak with you here at Say Yes to Profits. We would be delighted to discuss our Say Yes to Profits virtual CFO services that includes bookkeeping, financial planning, tax preparation, business advisory, and financial accountability all in one. Yes, you heard me correctly. The link to find out more information about Say Yes to Profits virtual CFO services is in the description. I hope that you enjoyed this video and received great nuggets. If you have any questions, definitely leave your questions below. And if you have yet to hit the like and subscribe button, please do that right now. This is Octavia. Until next time, say yes to profits. Toodles!
You have enjoyed another episode of the Say Yes to Profits podcast. Be sure to download the free resource from this episode and hit the subscribe and like buttons right now. Also connect with us on other social media platforms and join the free Say Yes to Profits community. Thank you for joining us. Say Yes to Profits.